Bollinger Bands Overview. Bollinger Bands are a widely popular and highly effective technical analysis tool used by traders to assess volatility and identify potential overbought or oversold market conditions and trading opportunities. Developed by technical analyst John Bollinger in the early 1980s, the indicator plots a set of three lines, a simple moving average SMA, and two parallel price channels, or bands, above and below it. The dynamic nature of Bollinger Bands makes them unique. As the bands automatically adjust to market volatility, they widen during periods of high volatility and contract during periods of low volatility. This adjustment provides a relative definition of high and low prices for a security, irrespective of its direction. Bollinger Bands can be applied to virtually any financial instrument, including stocks, futures, commodities, and currencies, and are effective across multiple time frames. What are Bollinger Bands? Bollinger Bands, a popular tool among investors and traders, help gauge the volatility of stocks and other securities to determine if they are over or undervalued. Developed in the 1980s by financial analyst John Bollinger, the bands appear on stock charts as three lines that move with the price. The center line is the stock price's 20-day simple moving average SMA. The upper and lower bands are set at a certain number of standard deviations, usually 2, above and below the middle line. The bands widen when a stock's price becomes more volatile and contract when it is more stable. Many traders see stocks as overbought as their price nears the upper band and oversold as they approach the lower band, signaling an opportune time to trade. While valuable, Bollinger Bands are a secondary indicator that is best used to confirm other analysis methods. Below, we guide you through how to interpret Bollinger Bands, when the tool is best used, and what other indicators are best matched with it. In this video you can learn and understand about Bollinger Bands in extensive detail in different topics. Outline of different topics are following. 13. Limitations of Bollinger Bands. 12. Divergence and confirmation by Bollinger Bands. 11. Bollinger Band breakouts. Trend confirmation. 10. Overbought and oversold conditions. 9. Volatility measurement by Bollinger Bands. 8. Interpreting by Bollinger Bands. 7. Components and calculation. 6. Evaluating the reliability of Bollinger Bands. 5. How to build Bollinger Bands for market analysis. 4. Meet John Bollinger. 3. What are Bollinger Bands? 2. Outline of Bollinger Bands. 1. Bollinger Bands overview. Meet John Bollinger, the innovator behind Bollinger Bands. John Bollinger, CFA, CMT, has been a major influence in technical analysis and is best known for developing Bollinger Bands in the 1980s. Bollinger combined his background in mathematics and engineering with financial market analysis to create this tool, which uses a moving average and the statistical measure of standard deviation to assess the volatility and trends of stock prices. The tool has since become a staple in technical analysis. He is also the founder of Bollinger Capital Management, a money management company, and has been a prominent commentator and analyst on market conditions. How to build Bollinger Bands for market analysis. The three lines that make up Bollinger Bands are based on a security's price moves. The center line is the intermediate term trend and is typically a 20-day SMA of the closing prices. The upper and lower bands are plotted a distance from the SMA set by a certain number of standard deviations, usually 2, above and below the center line. To calculate the bands, decide on the number of periods for the SMA and standard deviations for the upper and lower bands. While the settings can be adjusted based on your strategy, most times you would use a 20-day SMA and to standard deviations. The upper band is found by adding to standard deviations to the center SMA line, while the lower band is calculated by subtracting to standard deviations from the center line. The bands automatically widen when price volatility increases and narrow when volatility goes down. You don't need to break out your calculator and graph paper. Many popular trading platforms, like TradingView, include this technical indicator as a standard feature. Thus, you can easily overlay Bollinger Bands onto price charts. You can also usually customize the Bollinger Bands settings, increasing or lowering the periods and standard deviations to fit your needs. Because the bands are to standard deviations from the SMA, They show when prices are statistically high or low. Many traders consider the area near the upper band to be overbought territory. The price is poised to fall and a potential resistance level where sellers may step in. Conversely, the area near the lower band is often seen as oversold. The price is poised to go up and a potential support level where buyers could enter the market. Components and calculation. Bollinger Bands are composed of three key lines, typically using a 20-period simple moving average SMA as the foundation and a multiplier of 2 for the standard deviation. Middle band. This is usually a 20-period simple moving average SMA of the price. It serves as the baseline and helps determine the intermediate term trend. Upper band. This is the middle band plus a number of standard deviations of the price over the same period. The default is to standard deviations. Lower band. This is the middle band minus the same number of standard deviations of the price over the same period. The default is also to standard deviations. The default settings 20 periods and to standard deviations are commonly used because, statistically, approximately 95% of price action is expected to fall within to standard deviations of the mean, the middle band, assuming a normal distribution. Evaluating the reliability of Bollinger Bands. The tool's effectiveness varies based on the asset, settings, and other factors. Asset involved. Each security has different volatility characteristics, affecting how well the tool helps with predictions. Assets that typically experience sudden shifts in volatility might not have the expected behavior within the bands. Parameters. The default setting for Bollinger Bands is a 20-period SMA with bands set at 2 standard deviations away. However, this may not be the best option for all trading scenarios or time frames. Adjusting the settings could improve their effectiveness, but requires a good understanding of the markets and assets. Other indicators. Bollinger Bands are most effective when used with different tools and indicators. For instance, volume indicators and momentum oscillators like the relative strength index RSI or moving average convergence divergence MACD can give the needed context or help confirm signals from the Bollinger Band. Outlier situations. The bands are based on a statistical measure of standard deviation, which assumes that asset price returns follow a normal distribution. However, financial markets are known for having fat tails that sometimes lead to unexpected moves beyond the bands. Bollinger Band breakouts. While a touch of an outer band often suggests an overbought, oversold condition, a price closing outside a band can be a signal of trend continuation, particularly following a squeeze. Bullish breakout. A price close above the upper band following a squeeze often indicates the start of a new, strong uptrend. Bearish breakout. A price close below the lower band following a squeeze often indicates the start of a new, strong downtrend. A Bollinger Band breakout occurs when the price of an asset moves decisively outside the upper or lower bands. The bands are calculated using a simple moving average SMA and standard deviation, reflecting volatility. When the bands contract Bollinger squeeze, it signals low volatility, often preceding an explosive breakout. A close above the upper band suggests a strong bullish move, while a close below the lower band suggests a strong bearish move. Traders typically wait for confirmation, such as strong volume, before entering a trend-following trade. Breakouts are volatility signals, not guaranteed trade entries, hence confirmation is key. Divergence and confirmation by Bollinger Bands. John Bollinger advises using the bands in conjunction with at least 2 or 3 other non-correlated technical indicators to confirm signals. Momentum oscillators like the relative strength index RSI or moving average convergence divergence MACD are common pairings. Divergence. If price makes a new high outside the upper band, but a momentum oscillator fails to make a new high, a bearish divergence, it can suggest the uptrend is losing momentum and a reversal is imminent. Divergence and confirmation using Bollinger Bands (BB) primarily involve comparing price action with the indicator itself or with other technical tools. Divergence with Bollinger Bands typically refers to a price move that is not supported by the band's behavior or other indicators. A key example is price making a new high or low inside the band after previously closing outside it. Bullish divergence. Price forms a lower low, but a momentum indicator, like our SI or MACD, forms a higher low, suggesting selling pressure is fading. Bearish divergence, price forms a higher high, but a momentum indicator forms a lower high, suggesting buying pressure is waning. Confirmation involves using Bollinger Bands in conjunction with other technical indicators or price action to validate a potential trading signal. For instance, if the price touches the upper band suggesting overbought and the RSI is above 70 and a bearish candlestick forms, this provides strong confirmation for a potential sell signal. Similarly, a breakout from a tight squeeze, narrow bands indicating low volatility, is confirmed if the breakout candle closes firmly outside the band. Limitations of Bollinger Bands. While a powerful tool, Bollinger Bands have limitations. Lagging indicator. Like most indicators based on a moving average, Bollinger Bands are based on historical price data and are reactive, not predictive. They only show the current state of volatility and relative price levels. Limitations of Bollinger Bands stem from their lagging nature, as they are based on a simple moving average SMA and historical volatility. Key limitations. Not predictive. Bollinger Bands reflect past volatility and price levels. They do not predict future direction. False signals. They are prone to giving frequent, unreliable signals whipsaws in sideways or choppy markets when the bands are narrow as squeeze. Walking the band. In a strong, sustained trend, the price can walk along the upper or lower band for an extended period. Counter-trend trades fading the band touch in this scenario will result in premature exits or losses. Standalone use. They are not a standalone trading system and must be combined with confirmation tools like RSI, MACD to filter false signals and determine the likely direction of a breakout. Not a standalone tool. Bollinger Bands are not designed to be used in isolation. Signals should always be confirmed with other forms of analysis to reduce false signals whipsaws, which are particularly common in sideways or choppy markets. Ineffective in strong trends. In a very strong trend, prices can hug one of the outer bands for a prolonged period. Interpreting a touch of the band as a reversal signal in such a scenario can lead to premature exits or counter-trend losses.